All right. Well, listen, James, welcome to the podcast. Mr. Foss has been. This feels like an advertising campaign for Rail Bedford.
That's what we wanted it to be.
Yeah, nice one. I had Preston on the show last year, and he was wearing one of the T-shirts. And the following week, we sold about 20 of the T-shirts, but I hadn't connected it. I was like, we keep selling a lot of the T-shirts, and then I suddenly realized we released the show. So hopefully it'll work. But thank you for supporting that and going on stage and wearing them. And
that was good in Edinburgh. That was a real pleasure to be in Edinburgh.
We've had a couple of good conferences recently.
Great conferences. Yeah. I'm going to paraphrase, I actually quote Mark Moss last night. We were lucky enough to go out for dinner with Michael Saylor, and Mark was there. And he goes, I've never had so much positive vibes in the presence of a bloodbath on the price of Bitcoin, right? Like, and it's that's what I love about it, because even in Miami, we never talked about price. Edinburgh, we never talked about price. We never talked about price because it's still a rounding error, you know? We know that it's a rounding error in the big scheme.
It's all about the mission.
Correct.
We don't care about that. James, welcome to the show. It's great to get you on.
Thank you for having me.
Been a pleasure following you online. Not everyone will know you're listening. They all know Foss because he's been on a few times, but
Absolutely.
you could just tell people a little bit about yourself, a bit of a background if they don't know you.
Sure. First of all, thank you for having me. I've been watching for a long time, and it's awesome to be here. So
great, thank you.
So I've been an institutional investor for over 25 years, and in hedge funds, private equity, and I've just been an investor. And so I recently got into space. I kind of got in late, and you do it as you do. I've told this story before, so apologize to some of the listeners who've heard it before. But basically,
Greg telling me still early.
I'm so early. So it's 2018, and I'm trying to figure out. I wanted to invest some extra money I had, and I wanted to go out on the risk tail. Do something just a little bit different. Not real estate, not stocks, not bonds. Something bonds. Mm-hmm. And so, I wanted to find something different, and I kept hearing about this Bitcoin thing, and I was like, I've got to check that out. So, and being an institutional investor, you do what you would normally do is this is a new technology, so you go and you talk to the technology analysts. And but every single one of them, bar none, said, avoid it at all costs. It's a Ponzi. There's no underlying value. It's worth nothing. You'll lose all your money. Don't do it.
And they were right.
And so it turns out they were right. But the sad part is the price of Bitcoin had a 3 handle on it. So it was like $3,500. So that was the worst non-investment I ever made. And so I kick myself a little bit to the day, but everybody gets the Bitcoin price that they deserve, right? So later on, flash forward a couple of years, and I'm leaving the position I have in the private equity hedge fund that I was working on, and I wasn't sure what I was going to do. And my son knew this, and he was like, Dad, and he's at Cornell. He's a senior at Cornell this year, and he's really into technology and cybersecurity and all that. And he said, Dad, I really think you ought to give this crypto thing another shot. Go check it out, because he knew I was trying to figure out what to do. And so I did, and he convinced me to get some Ethereum, Cardano, and Solana. And so I leg in as we talk, as Greg and I might say on Wall Street. You leg into a trade, you get a little bit, and it forces you to do research, right? So I did that. And then I started watching podcasts and videos and got on Twitter and started talking to people. Saw you. I saw, Michael Saylor and Jeff Booth. And I was orange pilled within weeks. And I was like, I got to get my stuff all this money out of crypto and into Bitcoin. So
nice.
That's the journey that I've had. And that's how I've been in this space. And so now being an institutional investor, I love being here and teaching people about our world, and because it's so opaque and people don't understand, and it's not their fault. It's not taught in schools. It's not covered. Whether you're in grade school, high school, college, these things are not taught. And so I have people who have MBAs regularly coming up to both of us and the other guys, Larry Lepard and Mark Moss, and some of the guys that we're working with, that they can't believe all these things are not taught in schools, and they're learning stuff about it and how important it is in the world of money. and just the concepts around it and how it works. And so that's why I'm here. That was a long answer.
No, it's a good answer. We want long answers. We're a long form podcast. Why aren't these things taught?
I don't. Some people think it's purposeful, and that they're cynical about it. I don't think it's really that, as much as there's not really upside for Jamie Dimon to explain to you exactly what he's doing. It's not an upside for the bankers to explain exactly how they move the money around and make money off of it. I don't think they're trying to keep people out, but it's just like, if they have more information than you, they're trading in that. And that's how they've been in this world of fiat. And it's a closed world. It's a club, and they've benefited so greatly from it. It's not like they're actively keeping people out.
I'm a little more cynical. Yeah. I believe if they taught the truth, that people would question the stability of the banking system as a whole. They wouldn't deposit their money in the banking system, and that would cause the collapse. So,
well, maybe it's subconscious, but I don't disagree. But
very few people understand how risky banking actually is. I tell you that a bank is 25 times levered to its capital or risk absorbing equity base. That's a extreme amount of risk, where if you're a depositor, unless you have money printing to back it up, that's a high risk investment. But the system doesn't work if they don't have deposits in the commercial banking system. So you can't teach it.
But as an institutional investor, you would be aware how the system works. But since you came into Bitcoin, has it opened your eyes to other things? Have you become
completely?
Yeah,
completely.
What's it changed?
Well, I mean, I call myself a reformed hedge fund manager. Nice. And the reason is because, look, I was in that system. I benefited from that system, and I understand it. And now I can see just how damaging it is to everybody who's not really a part of that system, who's not really close to the spigot. And so it's literally changed the way that I look at money and the access to it. And, the separation of wealth in all of these countries, and how rapidly it happens, and how unfair it is. Like, the inflation is it's incredible. I never really thought about inflation before I dug into and studied Bitcoin, which is, just think about that. I was in investing for 25 years. The only thing I thought about is that is our bogey to beat, and when we're investing, that's how we get to our neutral rate, our real rate of return. And so it's just blown my mind that I've been doing this for so long, and I was ignorant in understanding it, and it's embarrassing. But
I think we all have that. I'm similar. I mean, inflation was one of those things you see on the news. Where they report inflation's at 2%, inflation's at 3%, and I just assumed that was a part of a naturally growing economy.
It's natural.
Yeah,
natural 2% inflation.
Yeah,
it's bullshit. It's evil.
Yeah, and we know that now. I mean, we sat down with Ovik Roy. Do you know Ovik? He's been on the podcast a couple of times. He operates a...
I don't know him, but I know who he is.
Oh, you know it. So he wrote this article recently for FreeOp, which was covering inflation. He said even at 2% inflation has an highly insidious effect on... No, actually, any amount of inflation has a highly insidious effect on the poorest in society. We're constantly making life harder for the poorest in society. I just believe that for economy to grow, you had inflation. I don't think I really grokked it until the time I actually sat down with Jeff Booth.
Exactly.
Read his book.
Boom. Exactly.
I was like, oh, okay.
Inflation versus deflation, how those forces are meeting, and they're going to clash.
Yeah.
That is his interview. That I watched an interview with him, and it clicked. It finally just clicked. I was like, okay, I got this. I understand. I understand why this is so important now. And so now that's all I want to do. I want to be in this world for the remainder of my career to figure out how to help. Like Greg says, it's for the kids.
Yeah. So you said you got a son who's a senior. I've got a son who's what would you say? Is a sophomore first year?
I think freshman.
Freshman.
Yeah.
Equivalent freshman. He's 18. I've got a 12-year-old daughter.
Yeah.
It fundamentally shifted how I talk to them about money and life.
Absolutely. And I've got a daughter. She's a junior in college. And that's exactly right. They're studying money in a different way, and they're seeing it in a way that I didn't see it when I was their age, not even close. And now he's migrated all the way to the Bitcoin. He understands that that's the future. So Bitcoin.
It's good how it does that to you. Well, it's great to have you here. Danny's a big fan.
Yeah, definitely.
Danny was the one who was like, got to get James on, and then
we've been trying to do it for a while.
and then because we have our rule, and then we have the pleasure of Danny saying today, "Oh, we're doing it with Greg Foss as well." I was like, yes.
But James was kind enough to say, yeah, let's do it together. And so,
come
on. No, because I would love to bring up the way James and I met. We were on a Spaces, invited to a dual Spaces. It was Resh, right?
Yep, it was Resh.
And we both, and I said, man, I gotta talk more to this guy. And it didn't hurt that he's a hockey player. He's very humble, but he was drafted into the NHL. Okay,
really?
Coming out of U.S. college hockey. And due to injury, otherwise he would have played for the U.S. Olympic hockey team, and he would have played for the Boston Bruins. Now, but as a Canadian, and he grew up close enough to the Canadian border that he could be an honorary Canadian if he wanted to be. But
because the
point is, we had that bond. He's a Ivy League educated kid that played hockey. I went to school at Cornell, where his son goes, right? So we had that bond, and we immediately reached out, and I could tell, man, I like talking to this guy. So happy to be here. This is James.
Yeah.
This is James's show, though.
The James show.
I'll chime in whenever you need me to.
Did you keep all your teeth?
I do. I have. There's some that are pretty loose, but yeah, I have all my teeth.
Okay,
but I've had my entire body X-rayed.
Is it? So it's that brutal?
It's pretty brutal. Yeah.
Okay.
Shoulders. The whole thing. Yeah.
So I don't know a lot about hockey, but I do know it's the nearest we have to our football in terms of the atmosphere, how difficult it is to score. It's slightly higher scoring than our football, but it's not like it's not like basketball. It's every
no, and that's why I love watching football. Soccer. I love it. It's the same. It's a lot of similar strategy. Yeah, actually, trying to create 2-on-1s and trying. It's a little bit slower and more methodical, but it's the exact. Some of it really lines up similarly. And we actually played soccer in off season training to work on plays and stuff.
And so you were drafted by the Bruins.
I was 1989.
1989. Okay.
I was on the U.S. national team my senior year, and it's a bigger team, so it's like 1.5 to 2 full teams that they're choosing the Olympic team from.
Oh, so pretty easy to get in then.
It's so easy.
Yeah.
So played in a tournament up near you, actually outside of Quebec, wearing the jersey, and and everything is going great. My senior year, I'm at the time, I ended up being one of the top 10 goal scorers in Yale history. And so, everything was working. I was like, I'm going to the NHL, I'm getting an agent. The GM for the Boston Bruins said, there are 2 players we're going to sign, Brian Smolinski and James Lavish. It's in the Boston Globe. And I'm like, this is happening. And just as it happens, senior year, we're playing St. Lawrence, just another team in our division, no big deal. And I'm taking a breakout pass from behind me. I take one step, my skate catches in a groove in the ice, and I get hit the same moment and blow out my knee, and it was over. It was all over.
Shit.
Yeah, it happened in an instant.
Is that an injury if you had now would be recoverable? It's got nothing
it's terrible timing. And the reason I was doing so well is because of my speed. I was one of the fastest players in the league. That's why that was my thing. I had like an extra gear. And to get to the NHL, that gear had to be like 20% more. And so at this point, and to the be on the U.S. national team, I was like, there's no way I'm going to recover. Everything was like, it was just like a couple of months before I had to go do all of that. And so it was like, it literally was the worst time.
How did you cope with that?
I went to Wall Street. And
so going to make a fuck load of money.
It was, honestly, I lost my identity for a little while. I had no idea what I was going to do.
Right.
I was so certain that this was my path that it was difficult. And I had loans, I had student loans, because they don't have scholarships, athletic scholarships at Ivy League schools. So I was under a little bit of debt, and I was in New York. I actually got traded to New York, the New York Rangers, and they picked me up, and I tried out with them, but I just wasn't there. And so they went on to win the Stanley Cup without me. And
Did you ever get to play a game?
I did, never, only an exhibition.
Right, okay.
So, but then I was in New York and I was just sleeping on friends' sofas and trying to figure out what to do. And one of them said, "You're really good in math, right?" And I said, "Yeah, I'm good in math. I can do math." And like, let me introduce you to some people. So they introduced me to some people on Wall Street. And next thing you know, I was working on the floor of the New York Stock Exchange trading something called ADR arbitrage. So yeah.
Was it on the floor with the people in the jackets and the tickets? Is that?
Yeah, it was no hand signals on that floor, but everybody yelling. It was crazy. It's not like it is today. I mean, it was nuts. There was paper everywhere. It was like this deep, And
Did it was that strangely give you a similar kind of adrenaline as to the sport?
That's it. So
yeah.
My flippant answer was I went to Wall Street, but what happened was that, like, look, you're good in math. You can operate quickly under pressure with a lot of eyes on you, and you understand how to adjust, readjust. There was a coach that was at Union when I was in college, and he had coached me in the summers a couple of times, and he said read, react, adjust, read, react, adjust, read, react, adjust. That's what you're trying to do, and it's the same thing. Read the situation, react to the situation, adjust, and those are but if you can do that really quickly. I mean, Greg will tell you, sometimes it's not the first trade you make, it's how you react to it, And so, especially when you're young and you don't know exactly what you're doing.
Famous hockey coach, Scotty Bowman. I grew up in Montreal, and he coached the Montreal Canadiens, but he had a line that 10% of life is what happens to you, and 90% is how you react to it. Okay? You're in a bad situation. If you react, generally you'll make the typical thing. And I hate to bring up Sam Bankman-Fried, but he reacted to a situation by making it worse, digging himself a different hole. I didn't want to hijack the conversation.
No.
Keeping it back to hockey. And there's something, so James and I took a walk today and we went down to the beach. And so I'm going to pull up the fact that James was sleeping on people's couches on Wall Street. I reacted that I had driven my mountain bike on a certain trip, and at one point in my life, that was my most valuable possession because my mountain bike was worth more than my car. My car was worth $800. I bought an $800 car, and I had a $1,200 mountain bike, and I figured I was worth about $2,000 coming out of college. And James looks at me, he goes, "That's a great story, Foster, because people think that we're just given stuff. We are entitled." No, James and I worked our talent, but it's not easy. We've achieved a level of understanding of the system, but no one handed it to you. You got to do the digging. You got to do the homework to understand, where you have an edge. So read, adjust, react. That's pretty cool. That's
well, six months after I launched this podcast, which is, what's the date today?
It is November.
The 13th of November.
Okay, so it'll be on the 17th. It'll be 5 years since first episode.
Oh wow!
4 months into launching it, 6 months into launching it, I was nearly declared bankrupt. I nearly lost my house.
Right.
Oh my God!
You gotta fucking work.
Oh yeah,
scrap. You just scrap.
Yeah, hustle.
So here's a funny story. When I was working for SG Warburg, the firm that I got hired by, I didn't have it. I mean, I literally had no money. So I charged a suit from Macy's on my credit card and 3 white shirts and 1 red tie and shoes and a belt. That's it. And I literally maxed it out to get that because I had like maybe $1,000 of availability on that card, right? And I'm going to work, and you know what it's like, right? To be on these Wall Street firms. I mean, it's brutal. Like the hazing back in the early 90s, brutal. So I walk onto the trading floor, like maybe the 4th day, and my boss pulls me aside. He goes, "Lavish, you have got to buy another tie. You cannot come in here wearing the same thing every day."
I remember when I was at university and I had no money, and I just learnt to code websites. And I'd only made one, and I went out with my friend to play golf. And afterwards, we were just in the bar having a drink and started chatting to this other guy. And he was like, "What do you do?" And I said, "Oh, I'm a website designer." He's like, "Oh, great. Well, like my company needs a website." It's back when it was very, he's like, could you do that? I said, "Well, yeah, I can come have a meeting with you next week." So then I went down to Hertz and I have rented a convertible because I wanted to be like convinced like I knew what I was doing. Otherwise, I'm coming on the bus. So I rented this convertible Saab and just drove it up there, and I got the contract. I got a £5,000 contract to build a website, which basically was the money I lived on for the rest of the year.
And you had to learn how to do it.
Yeah, I did. I had to get somebody in to help me off this freelancers board. But that hustle's there. I mean, and I think that's Bitcoiners.
Proof of work, man. Proof of
work. But I think Bitcoiners are hustlers. I mean, Matt Odell tweeted out today. He said, whatever people complain, he said, I'm working 5 jobs so I can stack more sats than you.
I like that style.
I think you find a lot of hustlers here in this Bitcoin thing. Let's talk about FTX, because it's kind of the big thing at the moment. It's depressing and it makes me angry.
I agree.
But I'm also interested in moving beyond that and saying what comes next. But I'll start with you, Foss. Like,
sure.
How did you take this whole weekend?
I'm disappointed. For 2 reasons. I'm disappointed, and I got to call this out as a Canadian. I'm disappointed that somehow one of our big pension plans got caught up in it. Okay, so the Ontario Teachers Pension Plan, one of the top pension plans in Canada, was a Series B investor. So along with Susquehanna and Tom Brady, our Ontario teachers had a substantial loss in absolute dollars. As a percentage of their portfolio, you're going to say they're going to walk it back and say that's a couple of basis points of our. That's not the point. The due diligence was absolutely horrendous. Sometimes these deals are club deals. Susquehanna's in. I got to be in. And we'll let them do the due diligence. But so I'm disappointed there.
That's true.
I could describe it. Shout out to American Hodl. I was on a Spaces chat today, and he was just laying right into them, as typically he does. So I think he's coming back on Twitter. American Hodl 8, I guess, is his handle now. I think it will get to 14 before long, but
before Christmas.
But I love the kid. But he was carving them a new arsehole, right? And it was beautiful. But the reality, he had a great statement. He goes, "The reach for yield is a fiat disease." Okay, like when you have to always pretend that there's a return that is somehow priced in, whether it's a bond or it's a yield by using option strategies or whatever, that actually is a fiat disease. So what I think is the best way I can describe FTX, I worked on trading floors my whole life, and it is a self-cleansing process because they make you go on vacation for 2 weeks where someone else prices your book. Okay, which means the trader that's sitting and it's a jungle on a trading floor. Okay, and sometimes the guy sitting next to you doesn't want you to make money because the bonus pool gets shared with the people that make the money, and the people that don't make the money, well, they get no bonus. So if you're having a really good year, but the guy next to you is having an even better year, there's a level of competition. The point is, you go on vacation for 2 weeks, someone else marks your book, which means prove that the marks are real. If you're short something, prove to me you can buy it back at that price without you adding to your position. And if you're long something, prove to me you can sell it apart from you being, the bid. And that's an efficient trading market jungle type of checks and balances. Well, the reality was Sam Bankman-Fried had no checks and balances. He was marking his book, and no one was there to overlook it. Now, he's a criminal, okay? Criminal. His CEO, who, she was a math major and everything, but she's self-professed. Well, I never had to use it. She's 23-something years old. I can't believe the world placed that much trust in these two monkeys, okay? At the end of the day, it's disgraceful. However, here's the soft-hearted Foss come out. He's someone's kid. In fact, 2 Stanford law professors. Are they law professors? Anyway, they both... they're both Stanford educated. I'm just sorry. If he was my kid, I would just be like, dude, why did you keep building and digging the hole for yourself? It started off by him thinking probably, I'll skate myself on side, but you never skate yourself on side. You dig a bit deeper hole by using this mark on FTT by defending that mark. And as long as you can defend that mark, well, the Ponzi doesn't collapse. So there were so many signals in hindsight. But I got to call out the private equity funds at the outset that they didn't do their due diligence. And whether or not this is true, the rumor is that he was playing that game, League of Legends, I think it's called, or whatever.
During the call with Sequoia.
But even during the due dilly that some people, at the outset of the Series B round. So hindsight's always 20/20. I'm ashamed as a Canadian. I'm looking back on it, like the checks and balances, certainly so easy to see. And then as a dad, like, man, kid, guys, when you get on side, read, react, adjust, or whatever
That's
you
right.
say. His adjustment was continue to dig himself a deeper hole. And then the Ponzi collapsed. So,
but isn't it crazy? So like today I tweeted out something that it's kind of like FTX is kind of like the long-term capital management situation plus the tech bubble. The pain for the retail investors in the tech bubble, right? So long-term capital management back in 1998, we talk about this a lot, both of us, but it was just a leveraged play. And then I thought about it more today, and I think I saw, maybe it was Caitlin who had tweeted this, and it really resonated with me, is it doesn't remind you of Enron? I mean, where you had all these off-balance sheet entities that were just marked by them and nobody knew exactly
Correct.
what the marks were. And so, and if you don't know what an off-balance sheet entity is, you should not be investing in crypto. And if you know what an off-balance sheet entity is, then you're a crook, and go ahead, you can invest in crypto. Because it's like, why these things were created by Enron to hide the fact that they were their price, their market value was marked up on nothing. And so, I mean, but they fooled thousands and thousands of institutional investors on Wall Street. And so
Enron did.
Enron did.
To be clear.
It doesn't remind you?
And so,
Hold on, what's that? Was it the smartest people in the room or something?
that's a book that was written on Enron.
Yeah,
correct?
I read that years ago. I feel like almost 2
And then
decades ago.
the chapter the book that's a great book for people to read on long-term capital management. It's called When Genius Failed. Both books should be
by
read.
Lowenstein.
Mine is I much prefer the When Genius Failed over the smartest people in the room. But that being said, they're both they're both must reads.
Absolutely.
I mean, look, I sympathize with what you say as a parent, and he's someone's son. I remember when Bernie Madoff was arrested and convicted, and they sent him to 150 years in prison. I was like, that's a lot of time. I mean, for a financial crime. Mm-hmm. And then I watched the film and I didn't realize 4 people committed suicide, including his son. Mm-hmm. And the emotional damage on so many other people.
Oh yeah, no, that's
and the amount of lives that were
awful.
destroyed. And I was like, hold on, this is a broad crime that affects a lot of people.
He is absolutely the criminal. And that being said, when I say as a father, he's going to have to do time. If the problem is, as a father, you just had wished he had reached out when he needed more guidance, rather than digging himself a deeper hole.
I wonder where it went wrong though. Like it'll all eventually come out. No. What I mean is like, was FTX created because Alameda already had a hole, or was FTX created because Alameda was so successful, and then there were issues later on? And where did it go wrong? Where did he make that first bad decision that led to the next one, to the next one? Like, I can't figure it out.
We may not know for years.
But we all know that if you're in that situation, it's like you're making a decision where if you don't get away with this, you're facing years, if not decades, in jail.
I promise he didn't think that far down the path, and that's the danger of being young and unaware. You're just too young. You don't understand. Last night, and not to dox too much, we had a great dinner with Michael Saylor. Let me tell you, that man continues to amaze me with his brilliance. And it came up, like, where do his ethics as a publicly traded company originate? And he's very clear. And sorry, Michael, you can cut this out if you need to. But the truth is, he goes to the SEC. Look, people are scared of the SEC. Sam Bankman-Fried didn't have any reason to fear a regulatory body because they don't oversee his fund.
Right.
It's like having absolute control over your own empire, and there is no you don't have
There's no repercussions.
No repercussions. You don't have to answer to anybody. So you can mark your book however you want, as long as people don't realize that it's the fraud that it was.
Right.
Yeah, I mean, gosh, people won't like me hearing me say this, but sometimes I'm like, maybe we do need regulations, or I mean, maybe we do.
Absolutely.
Over to you, James, because we absolutely
like
need
I'm not an anarchist.
I know you are,
but I do like the idea of a smaller state. I do like the idea. I don't like accredited investor rules. There's a lot of things I don't like, but
well,
at the
I mean,
same
they're
time,
outdated. They're not. I mean, they're not.
Yeah.
Really, they cause more separation of wealth. Yeah.
But this wild west of anyone can do anything and get away with anything. I don't know. Certain things I think need regulation.
One of the most influential courses, and I said over to James, that I took at Cornell 1988. So 1987. How many years is that? Like close to, 40 years, right?
120.
But anyway, 35 years. A great class I took was called The Efficient Amount of Regulation. In any system, there is required amount of regulation. Okay, it's that simple. And within let's say crypto, and make sure we understand the difference between Bitcoin and crypto. If you truly want institutional adoption, which is the thing that will make number go up, you need a level of regulation that will allow those investors comfort that they are not entering into some sort of potential Ponzi that was mimicked by FTX.
Well, this was Tyler and Cameron Winklevoss's point. I mean, people didn't like the campaign. Crypto needs rules, and I would prefer it to be a bit more Bitcoin, but that's the exact point they're making. It's like, no one's going to touch this if it's a Wild West. No one's going to touch this. I mean, how much capital has been eviscerated this last week? That is actual venture capital. How much of that has just been destroyed?
Right.
And like anyone looking in on this must be like, what the fuck is this all about?
Yeah.
Correct. And then don't forget the contagion that's involved. Over to you, James.
No, I think we were talking about this morning on our walk, and that's why you said over to me. And I just don't think that institutional money, like real institutional money, is going to come into this space until we have proper regulation. They're too scared of it. I mean, if you're a portfolio manager or a chief investment officer, what's the upside to getting into the space with so much risk, with so many of these schemes that have been unearthed in the last year? There's too much career risk in it. So they're not there's not enough upside to outmatch that.
Some Bitcoiners would say, yeah, good. Let's not have regulation. Let's leave it. Let's have a grassroots movement. Leave it for the little guy.
You can't suck and blow, okay? If they want the price to go to where they want it to go to, it will not happen without the big money.
Well, I think someone will say, well, let that come later. Mm-hmm. Let's build this a little
bit
slower.
Agree. Yeah. I would agree with that, but
I'm in the middle. Look, I'm in the middle. I just hate people getting fucking screwed.
Oh,
yeah, exactly.
There are people that will. I'm aware of people that lost their lives due to Luna. There will be people that lose their lives, take their own lives due to FTX and the losses that are absorbed there. In the grand scheme of things, in the global financial marketplace, the losses will be de minimis, okay? Within our ecosystem, there will be repercussions for a long time. Yeah. But from a global financial perspective, it's wipe it off the table.
Why? How could there have been so much systemic failure in the due diligence with this? Because I don't understand how a Sequoia can write a $200 million check without some kind of deep due diligence. I just don't understand it.
I mean, it's a good.
Is this a fiat problem?
No,
but
sorry, it is a fiat problem. I know what I want to answer, but you go first.
Well, I mean, you're marking things to market, and FTT is marked where it is. Then you see how much it's trading, or what the number of holders are and who holds it. Then you have a certain level of comfort, and it's just how much comfort does that one mark give you? That's like a starting point for some of these guys, Okay, let's start with what are the assets? But as far as all of the entities, I don't understand how they didn't pull this apart. I mean, how
about, okay, so I'll take it a step further. Yeah. One of the tough games in private equity is, you want the next round always to be higher than the previous round, right?
No doubt.
And when you have a down round, which means a down pricing round where your Series B is lower than your Series A or whatever, that's not good for the valuation on your books. Right. Well, a lot of these guys will fund things at a higher valuation just because. It's good because they can take the stuff that they already have on their books and mark it to the new valuation, right? If they were in Series A and then the Series B round clears at a much higher enterprise value, that's good for the performance of the equity fund.
That's a little bit Ponzi itself, though.
There's no doubt that there are issues coming up about private equity marks on the private companies that they have funded.
So the way it works is in private equity. That's a great point. So the way it works in private equity, you come up with a valuation technique, and you try to you should keep it consistent throughout the life of an investment. You know, whether you're doing discounted cash flows, or you're doing comparable valuations, whatever it is, comparable multiples, you know, to public companies. Those are pretty good metrics to use. You decide how to do it. You come up with your paperwork, your back work, your any information that could back it up in your models. Then you go to your auditor at the end of the year, and they look at how you valued them, and they decide whether or not to sign off on it and say, yeah, this is a believable valuation, right? So that's it. And unless you're audited, that's it. That's as far as it goes. So if somebody decides that they can, I mean, it's not that the auditors are stupid. It's not that they're criminals or anything like that. It's just they're trusting their client. Now remember, the client pays the auditor to audit their books. So, they're paying them to do this work. So it's a very close relationship. And so not to be cynical there, but let's be cynical. There are times where the auditors will just take your word for it and just go, I've got a lot of work. It's the end of, and like when March 31st comes up, these guys are so busy. They're so busy that they're like, okay, I'm going to have to take your word for it. And I'm
going to be cynical a bit.
Just a question on that very quickly.
You're cynical the whole show.
But
it's okay.
within Sequoia, whoever signed that off, would they face consequences, or would it be like they'll just write it off? Nah, this shit happens.
I believe it more closely to your second. VCs make money. There's in 10 investments, 7 will go to 0, 2 will break even or slightly better, and the one that knocks it out of the park makes your return on the 10 investments that you've.
Yeah, it really depends on how big their investment is within the portfolio that the portfolio manager wasn't.
Let me pull a little bit more of the conspiracy theory. What if you do know that it is something that you have discovered there's fraud, but you want other people to come along and still mark it higher so that you're allowed to mark your prior investment up to the new funding round price. And you're like, damn, I hope they don't realize the things that I've realized up until this point, and I'll let them skate the project to the next level. Yeah. Okay.
Pass the hot potato.
Yeah. It's not passing it as much as just let's all hold our breath and pretend it actually isn't as bad as someone has discovered it to be.
Yeah, so going back to what you're saying about the reaching for yield, and we saw it. So people are thinking like everything's breaking, the crypto's breaking, the bonds, the bond market's breaking. What happened in the UK? Well, go back to reaching for yield. So in the UK with the pension system and what happened when the gilts collapsed, I mean, it's because you have these pension funds that they need to create a certain amount of return over the life of their investment fund, which is in perpetuity, in order to pay out these liabilities that they have. They have to pay out their pensioners, right? And who are the members of that fund or schemes, as they call them in the UK, even though that's kind of a negative connotation here in the United States. They're called pension schemes out there. Well, the problem is that when you have interest rates manipulated so low for so long, I mean, you had a very difficult time in Europe trying to find yield. There were $15 trillion of negative yielding bonds. This is nominal, negative yielding bonds last September. So, I mean, trying to figure out a way to make enough money to pay out those future liabilities is an issue, right? So what happens is the pension funds have to figure out a different way to do it. And so enter the LDIs, which are liability-driven instruments. or investments.
Investing,
And so, and what they are is they're just swaps, right? And so there's nothing inherently wrong with a swap. You can use a swap to create returns and to minimize risk, right? And we'll get to the third way to use them, but creating returns, and with a swap, because you can swap out, what you have on your books in order to make an investment in wherever the way you need to make it, right? So, but to minimize risk, you can swap out floating interest rate instruments or securities into something that's fixed, so you can have a predictable cash flow. You can swap out currencies. So if you have some sort of investment that is not in your base currency, that you can swap that into it, so you don't have that currency risk over the life of that investment. But then you can also use them to leverage. And this is exactly what they did in the UK. And so they would use these instruments or these investments, LDIs, in order to lever up the returns they were getting, because if they were getting just a few percent, they could lever that up 2, 3, 4 times that in order to make a better return, right? So if you're making 3%, you can lever that up to 9% or something, right? 3 times or whatever it is. I mean, when I was doing swaps back in my arbitrage days, I only had to put down 5 to 8% collateral on our swaps. And so think about that. I mean, that's like 20 to 1, right? That's a lot of leverage for that investment. Well, these guys are doing this in their books, and then the new the finance minister, right?
Kwasi Kwarteng.
He came out and said that he was going to have this massive tax cut, right? Didn't tell anybody where the money was going to come from, and just said, we're just going to have this massive tax cut.
And increased spending.
And the market literally imploded. Like, it was like, whoa. And so anybody who owned gilts, the UK bonds, they were like, where's the money going to come from? This introduces, this is going to be a problem. This is going to be negative real rates for as far as we can see now. And so they started selling these bonds off. Well, they started selling them down, and the UK investors, these pension funds who had these LDIs, well, remember that if you have something that's on leverage, you have a margin requirement. And these started dropping down and getting close to the margin requirements, and they were going so fast that some of the pensions were now underwater in their investments. So they approached the Bank of England. They were like, if you don't stop this, we're done. We're all insolvent this afternoon. And so, I mean, and again, it goes back to what you were saying, reaching for yield. And that's the problem. And this is the fiat disease that you're talking about. Exactly.
Well, this is the interesting thing. I don't have a pension. The reason I don't have a pension is when I got divorced, I had to split my pension. And I went to a pension advisor, and they said to me, like, how much money do you want to live on a year?
What would you have had a pension from?
Well, I had... just from my company, I had an advertising agency. So I used to put a certain amount each month, and you could match that tax-free with the government, like, incentivized it tax-free. Yeah. It wasn't a great pension, but anyway, I went to a pension. I only did it because my business partner said to do it. Yeah. But I went to my pension advisor and financial advisor, and they said, how much do you want when you retire to live on? You'll have a lump sum, but how much do you want to live on? I was like, I don't know. I mean, 40, 50 grand a year would be great, but decent amount of money. And they said, okay, you need a pension pot of 2.2 million. I was like, huh? You what? They said, yeah, so you need to save 2.2 million for the rest of your thing. And we were talking, I was like 35 at the time, 45. So
that was their projection. Yeah,
so I was going to work 30 years.
Yeah.
So I'd have to, even if I earn 100,000 a year, I couldn't do it. Mm-hmm. So I was like, I'm just not going to have a pension. So what I'm going to do is I'm just going to earn as much money as I can, and I'll work until I have to work. That's just going to be my life. And if I work till 70, so that would be it. Obviously, the thing I've discovered now with Bitcoin is you look at this and you go, this fiat disease is that if you want a pension, you've got to constantly be chasing the inflation number and beating it, outperforming it.
That's right.
The great thing about Bitcoin is you kind of with the deflationary currency, you just have to have savings. And if you're saving in something that is deflationary over 40 years, by the time you retire, you've got your nest egg, you're good.
You're good.
And you haven't had to do anything. You haven't had to steal from anyone. You haven't had to lie to anyone. You haven't had to fucking anyone over. And like these little pins keep dropping.
Yeah. Exactly. That's exactly right.
Yeah.
That's it.
Well, anyway, so back to, I don't know, we got there from Mr. bankrupt fraud. But
Reaching for yield.
oh well, interestingly, it's a coincidental number. Your price target is now 2.2 million. Interesting. It's my pension number.
Isn't that?
I would have just needed one Bitcoin.
Now, are you referring to a tweet I sent out that? Yeah, that was half in jest because the value of Bitcoin has actually gone up. The price of Bitcoin's gone in the other direction for various reasons, but the price has gone up. I increased it by 10% because I view that as being the positive contribution by getting rid of some of the shitcoinery that's going on within this asset class. But I've run through that number with you before, Peter. How I get to 2 million. It's pretty simple. Grade 11 math. We could run through it if you want, but the reality is, I sent that out by trying to make a point that the value of Bitcoin, with all these things that have gone on, macro events within the TradFi world, micro events within the crypto ecosystem, all have led me to believe my valuation for Bitcoin is higher. And why is that? Well, because the likelihood of you needing the insurance against the system has increased, meaning with all the mistakes the LDI, the pension plans are making, you need to have insurance that there's some other asset there that's going to protect you.
But we're not really at that point where Bitcoin is reacting.
Not yet, because it's education, but also there's still a lot of levered money on Wall Street that is trading Bitcoin as a risk asset, when in fact, it's going to take a lot of education to teach the hot money, let's call it what it is, it's hot money, to understand that Bitcoin is a non-correlated asset that actually is insurance, which means it shouldn't be traded as a risk asset. It's actually the flip side. As risk increases, which it is in the world, Bitcoin becomes more valuable, not less valuable. That hasn't permeated the thinking process on Wall Street yet. Why? Well, they don't teach it to you in school. When you come out of an Ivy League school, and you're working on Wall Street, perhaps some of the things you were doing to begin with is writing an algorithm to discover a correlation between Bitcoin and NASDAQ stocks. And historically, it has reacted like this, so the algorithm will program it to continue to act that way until further notice. It takes a lot to break down these bad models.
What's your time scale? Sorry.
Well, here's the key. 2.2 million in today's dollars. So I have an expression, give a target, but not a time. Well, we're measuring it in today's dollars. So if it takes 20 years to get there, what is the value of today's dollars?
Oh, you think it's worth it now?
I can give you the math that indicates to me that it should be trading there. But it's only here. I'm going to flip it on its. Well, I'm going to flip it on its ear. I'm a probabilities guy, okay? And I'm never 100% certain of my investment outlooks, but what I do try and measure is what the market says my odds are, Peter. Yep. So you take, and it made the math easy when it was $20,000 versus a $2 million price target. 20,000, and it's in today's dollars, versus 2 million. You take today's price target, you divide it, trading price, you divide it by your target, and you get a percentage of what the market says your odds are. That's a 1% chance. The market is telling me I have a 1% chance of being right. And I'm not saying I'm 100% certain I'm right, but I'm way higher than 1%, ladies and gentlemen. And that's how I've always managed risk my entire career.
Right. And for anybody who is watching this and saying, yeah, but you've got to put an interest rate on that for, to discount it. We're at negative real rates.
Okay, so that's fair, really but matter. I also stress it is today's dollars. Let's not mess.
So what I'm saying is it doesn't matter because we're at negative real rates. So it's even better than that.
Because the interest rates are lower than inflation.
Yeah.
Correct.
Yeah. So it's even better than that.
But again, bring it down to first principles, Jeff Booth thinking. It's like going to the racetrack this year for the Kentucky Derby, and you had watched the Kentucky Derby winner train all the time. And you know what the odds were going into the Kentucky Derby of that horse winning Kentucky? 80-1. And that's where the odds closed. And if the guy who had spent his life studying horses had watched this horse train, he's like, okay, 80-1 is a long shot. And I still don't think he's a lock to win it. But man, the odds aren't 80-1. Maybe they're 25-1. So that's why you have to take opportunity of wrong odds that are laid by a racetrack or by a market. All the same thing comes down to risk management.
Yeah, and we did the same thing in arbitrage. You'd look at whether a deal was going to close, and you would handicap it. And if the market said it was like a 30% or a 40% or a 50%, and you thought, God, they're either I'm missing something or they're out of whack on their price. And that's where you would take, if it's a compelling opportunity and that risk reward is so great, then
I again, it's James's show, but I can't keep my mouth.
It's our show.
It's our show. Hey, asymmetric investments define careers. Right. Okay, that's as simple as it is. I've had 3 in my life, asymmetric investment opportunities. This is hands down the best I've ever seen. It's not even close. The other 2, which were the best up until my, my current introduction to Bitcoin, they were good, but the asymmetry of Bitcoin is just so beautiful. Hands down, this is the best opportunity I've ever seen.
Agreed.
Yeah. I think it's I missed the internet one and I should have taken it.
Coulda, woulda, shoulda.
Yeah.
That was uncertainty. But, if you had 0 exposure, you were also on the wrong side of that trade, right? But this is how you line it up. And mine came out of the second one came out of the great financial crisis. And, the asymmetry was just crazy. And there was so much of this available. I was able to buy $7 billion of something for our fund that's why I hung up my cap at the end of the great financial crisis and, 4 years later, because I said, I'll never be able to recreate that opportunity. Yeah. And guess what? In 2016, I found Bitcoin, but I wasn't managing money professionally anymore, except for my own account. And that's why I've gone in with both feet. So lucky to meet a guy that speaks the same language as I do. Because that's all it is. Managing risk is managing probabilities. It's managing an expected value outcome. And that's what I take such exception with these knuckleheads on Wall Street who say, it's got no value. Okay, are you 100% certain of that? And they'll say no. And I'll say, then shut the F up because you have to play probability distributions. That's where you're dealing with the fiat mindset versus the reality of managing risk.
And really the challenge is to get some of these institutional investors to leg into the trade, get some, so it forces you to do the work and forces you to do the real research on it. And then they'll be orange pilled if they really, truly do.
What about your old buddies on Wall Street? Have you talked to them much about this?
A few, and I've got 1 or 2 that understand it. Like literally a handful.
They already did, or you spent some time with them?
No, they already did. But beyond that, I mean, they're just they group it up with Ethereum and Web3 protocols, and they're like, they just don't understand how it's different. They think it's all crypto, and I'm just getting a little bit of each, and we're trying to, they don't understand it, and they haven't done the work on it. They're mentally lazy,
intellectually lazy.
It's correct. Intellectually lazy. And it's incredible. And there's going to be a lot of them that miss the boat, absolutely miss the boat.
Can I add? So the cool thing is the one guy that was one of my biggest counterparty traders in this first, coming out of the great financial crisis, he was a JP Morgan trader. He just messaged me yesterday on LinkedIn because he's been following it. He does not want Bitcoin to succeed, but his spider senses are indicating.
Kicking in.
Well, he's like, hey, Foss, let's talk more about this. And I'm like, fine. I'll go into anybody's barn and have a discussion, whether they're crypto, whether they're fiat based, because it's an education process. And there's a lot of people that are paid not to want it to succeed. Okay. But there's enough smart Wall Streeters who know they have to cover their ass as well from a risk management perspective.
Well, I tell you what's been interesting on this cycle is the previous cycle, it was very much the kind of like the Bitcoin educators. It was the writers, it was the techies. This entire latest cycle has been dominated by macro people. I mean, we have you, James, we have you, Greg, we have Lynn, we have Preston, we have Luke Woman. I mean, Jeff Snyder now, Larry Lepard. And even though Jeff Snyder isn't a Bitcoiner, he kind of is and doesn't know.
No, he doesn't realize it.
He doesn't realize but he is. I mean, same. We've got so many now, and our show isn't a Bitcoin show anymore. It's a macro show. And the reason I can tell you that is I can make a show with Lynn Alden. We can not even talk about Bitcoin, not even have it in the title. It would be the biggest show of that month.
Isn't that interesting?
Yeah, this one will be a big show. People want macro. They want to understand money. They want to understand the wider context.
Yep.
Of course, they want some Bitcoin stuff as well. But the macro people have driven the engagement and the interest of this cycle, and there's more of them coming, and they're smart, and they're coming out with great arguments.
And the 60-40 portfolio, which is the traditional 60% equities, 40% bonds, has been decimated this last year. It's the first time in 100 years that both strategies have been down double digits, okay? And that means that there are asset allocators out there that need to find new ways of meeting their bogey, which if you're a pension plan and you're assuming you have a 7% hurdle rate and you just lost double digits negative combined, you need to find something that's going to bring that return up or diversify your investment portfolio. So it's happening. Fidelity is the leader on the institutional side this way. And look, BlackRock is doing it, kicking and screaming. Larry Fink didn't want to do it until he realizes he's losing clients to Fidelity unless he does it.
Or opens it up to the individual investors are the ones who are clamoring for it. They want this. And so now they have to listen to it. But we talked about this the other day. And like there are 5 institutions that control $30 trillion of assets in this world. You know, you've got Fidelity, Vanguard, BlackRock, State Street, and UBS that control $30 trillion. So when they get in and they actually put it in their portfolios, it becomes a no-brainer for other asset managers to do it as well. I mean, that leads them to do it. But again, going back to our original point, which was we need some regulation in here to get them comfort to understand how Bitcoin is different, because the regulators are going to tell them Bitcoin is different, and they'll go, oh, okay, and it'll click finally, and they'll say the career risk has been, it's been taken down, and so I can now leg in, and they get in a 1%, 2%, 3% position. What's the math on that, right?
It adds up quickly.
It adds up quickly.
Yeah.
What kind of regulation do you think is required?
To show exactly how Bitcoin is different, how it's regulated as a commodity versus all the other crypto regulated.
So
security.
CFTC oversight.
Yeah, all that stuff. And
non-market manipulation.
Right.
Okay.
Yeah.
One of the reasons that the SEC is comfortable with a cash settled futures product, BITO, is because they feel they can regulate the trading in the Chicago pits versus cash settled Bitcoin, which trades globally, and they believe could be manipulated by Asians, let's say, overnight, London time.
Or Russians.
But here's the cool thing. As a member, and Peter, here's the cool thing. You had Sean Cumby, or you talked to Sean Cumby the other day. Sean and I were involved in the first Bitcoin ETF in Canada that allowed Canada to have a spot ETF. That's advantageous for Canada, leading the charge. And Sean Cumby was responsible for taking the OSC to court and proving that it is not manipulated overseas. Sean was brilliant on that fact, and Canada's better off for it. So it's coming. It's called the theory of agents. Career risk is easy when no one else is doing it. I don't want to get out of my lane. If everyone's losing money, that's great. I don't want to be the guy that's losing money because I went on a different strategy and everyone else is making money. That's the career risk. Theory of agents is the problem.
Damn. Well, going back to the macro stuff,
Yep.
When you talked about double digit down on bonds and equities, do you see a recovery or is this just a death spiral?
A recovery in bond prices?
But either.
Okay, so absolutely. I mean, look, bonds have now gone from a 1.5% US 10-year to close to 4%. It topped out at higher than 4%.
By the way, is that actually a good thing? Should bond rates really be at that
They
rate?
always should, yes. And they're still not high enough.
Right.
Because you still have nominal yields after you subtract out your CPI.
You have your real
negative
yields,
real rates. That being said, there's an element, and I said this on stage here in the conference, that people are going to change from being worried about inflation to being worried about credit risk of the USA. And that's what an interest rate is. It incorporates an inflation expectation and a concern about credit risk. And up until now, nobody in the world has worried about the potential default of the USA. But guess what? and I saw the chart you had there, the graph of the Congressional Budget Office that showed the deficit in the USA, that graph right there.
Keep it up, Danny.
It is a beautiful, if this was a company,
Yeah.
you wouldn't touch this thing, okay?
Right.
This is so ugly.
Foss,
you look at this. Yep.
Explain this to people listening on the
So
phone.
the primary deficit, okay? The components of the total deficit is the combination of the purple and the blue. But the primary deficit is your fixed costs. It's your military spending and it's your entitlements. Yep. And correct me if you see something else here, Jim.
and others,
Okay.
right? So those are the ones you just listed are mandatories. They're under legislation, but
This is the government budget.
This is the government, and it's
Right.
done by
Basically.
the Congressional Budget Office.
which means that it's quite optimistic.
Doesn't matter. It's still so pathetic.
Which is pathetic.
Is that you are going to have a total deficit in 2051, okay?
What's that, 15 trillion?
This is, no, it's how much on an annual basis you are losing. You are correct. It's $15 trillion negative.
It's not a percent, it's an actual number.
Correct.
Yeah.
Okay.
And is this accumulating every year? Or is
Well,
this a
don't
separate?
forget, when you don't pay off last year's,
Yeah.
you have to pay interest on it, and it gets bigger.
But that's not the number each year. That's the increase.
No, that's the number. That's the total debt deficit. Well, that's the
They're not
increase.
in-
Yeah,
yeah,
exactly,
so they're
exactly,
increasing.
exactly. So yeah.
Why is
So
it going
it's
to?
deficit as a percentage of GDP for the USA? You're getting a deficit that's 15% of the GDP of the USA annually. And the biggest component is your net interest, which is because the interest coupon has to roll over and fund the deficit from the prior year. So it's organically growing because of the debt spiral.
So let's talk about that for a second. So this is a great chart because it shows that the CBO, the Congressional Budget Office, admits the problem.
Yeah.
But let's talk through the real problem, right? So going back to what Greg was saying, so you've got your GDP, right? We're
Hold
already
on, just one second, James. I just want to explain to the people listening just what we're looking at, and we'll put it in the show notes. But essentially, what we're seeing is the deficit year by year. We have an anomaly in 2020 and 21 because of COVID, I imagine.
Correct, that's
so there's a
exactly what it
massive
was.
amount of borrowing.
Yeah.
And then what we see is going to drop back in 2022 to about 5%.
Correct.
Okay, and then
of GDP. Now
of
let's
GDP.
be yeah.
Okay, and then from 2027, it's gonna be about the same, but it's gonna go up to about 15% by 2051. But the majority of the increase is interest.
It's ridiculous.
Correct.
All right, so
Yeah.
let's just walk through how it's ridiculous. Right now, first of all, our baseline deficit right now is $1 trillion.
Yes.
Okay. All right. So let's walk through the numbers really quickly for your listeners to understand what Greg is talking about. And we talked about this, and that's why I wrote that newsletter about the debt spiral in the United States. Right.
Yes.
So. Okay, so you have your major revenue source. That's your taxes. I mean, they have other things, their penalties and stuff like that, but your tax revenue is your major source of income for the United States. Okay, and that's driven off of your GDP, your gross domestic product, right? So and that right now is running at about $4.5 trillion. Oh, no, I'm sorry,
That's okay. 4.5 trillion is your tax revenue.
Right. All right. So you've got that's right. So you've got your major expenditures are your entitlements. Okay, these are signed into legislation. These are mandatory expenses, right? Which is about
Social Security.
Social
Yeah,
Security,
Social
Medicare,
Medicaid, yeah.
right? And that's $3.7 trillion. Then
Hold on, what's GDP of?
GDP of the USA about 24 trillion.
And tax revenues are about
4 trillion.
4 trillion, 4.5 trillion.
So hold on. So 2.7 trillion of that is mandatory.
Correct.
Does that include the military?
No, 800 million. 800.
So let me walk through it. So it's $3.7 trillion is mandatory. Then out of your variable expenses that change year to year, you've got military, okay, which is $800 billion. But those are contracts. So you kind of count it as a mandatory because they're invoices that they're getting from these contractors that they've agreed to, make these defense products for them, right? Or defense systems. So then that's 800, right? Then your current interest on your debt is at $400 billion. Okay, so now walk that back. So the number is actually $4.8 trillion of revenue. Okay, You've got 3.7 trillion in entitlements, 800 in defense. Now you're at 4.5. Then you've got $300 billion left over for interest expense. However, today your interest expense is at $400 billion. So you're already running an additional deficit of $100 billion, okay? Now, Larry Lepard and I sat down before this conference and talked through a pro forma of next year. So a pro forma is just a projection on your baseline. So, okay, remember, your total, if you include everything, so forget about the mandatory only. If you include everything, we're running at, right now at about $1 trillion of deficit, right? But now next year, if you peel out from our revenues the $600 billion that we got, which was kind of a one-time deal in 2020 after all of the money printing and the stock market, all the assets went up. They had a great capital gains revenue line item of about $600 billion of additional, right? So pull that out. And then also we have right now about $400 billion of additional spending that the government the Treasury has said that they're going to have to issue bonds at going into the fourth quarter, into the first quarter. Okay. So now you've got the 600 plus that 400 plus another $150 billion of the COLA, the cost of living adjustment on those entitlements, right? So that goes up by another $150 billion. So you're about at another $1.2 trillion. Add that to the $1 trillion deficit you're already at. That's $2.2 trillion, okay? Now hold that, right? So clearly, okay, we'll go back to that in a second, but then when you add in that we're going into a recession, and the last two great recessions we were in, which was a tech bubble in 2000 and 2008 was the great financial crisis, your tax revenues dropped between 8 and 10%, and your entitlement spending went up between 8 and 10%. So now that's all another $800 billion to $1 trillion, okay? On top of that $2.2 trillion, if we go into this downward economic spiral, or at least into a hard recession. So now you're at over $3 trillion. Now look at the chart and see how rosy that picture is from the CBO. Even though, okay, so if you look at 2026, it's showing what? 5% as a percentage of GDP. Remember, GDP is $24 trillion.
So 5% is 1 trillion.
And that's going down.
Okay, so this is bullshit.
Well, but it's still so ugly.
It's still so ugly.
If this was a company, you would never touch this with a large pool.
Exactly.
But the thing is, if this was my household budget, what I would be doing is going, I've got to cut something out.
No, what you do is if you're
or
the
get
US
a second
government,
job.
if you're this is what the U.S. government is doing. Okay, if they're assuming yes, exactly what you just said, but instead of cutting spending or getting a second job, they can't get a second job. Where are they going to drive revenue from? Instead of what they're doing is they're operating on credit. So they've got a credit card that they're overspent on, and they've got an interest rate on it. So now their mandatory expenses of your mortgage and your car payment and food, right? So you've got all those things you've got to pay for you and your kids. Well, you're not meeting that margin with your job, with your revenue. So you can't cut out you're not cutting out food, your mortgage, or your house. So what are you going to do? You're going to take out another credit card. And then you're going to pay the interest on that credit card. And then eventually you're paying so much in interest that you have to take another credit card.
There's your blue line.
And that's the blue line.
That's your net interest. And that's what, so it's the equivalent of being in credit card hell. Okay.
It's a debt spiral.
You are taking out more credit cards to pay the interest on your old credit cards.
And this is why there will be a default at some point.
Or
this gets to what
they print a load of more.
Thank you very much. The fiat currency is the error term which balances this debt spiral.
So they print out, pays back in normal terms, loses
to oblivion.
As long as it continues going.
Does that affect credit rating though?
Okay, absolutely it does. But that's why the credit rating
question.
Companies are conflicted. If this was a corporation, there is no question it would be rated CCC. Okay? It's a very simple calculation on EBITDA interest coverage. And the USA does not even cover its interest expense by one turn. James ran through the math, which meant that as a company, those are defined as zombie companies. Well, guess what? the USA is a zombie country, and it's the best country in the world from a financial perspective.
There were times where we would run a surplus, and there were times where we would run a deficit. And it just feels like we never have a surplus anymore.
Okay, why? Because your organic growth in your debt is at a point where the growth in your interest is outstripping the possible growth of your economy.
But why is it happening now and not? And I've got a couple of theories. I think one is globalization. I think who's going to blink first?
No, Paul Volcker was able to do what he did because total debt to GDP in the USA at the end of 1988 was 30%. And now total debt to GDP in the USA is 130%.
But why have we got there
so
now?
Think about it. So just think about it. If your interest rates are going up, right, and you're running a deficit, well, now your interest payments they're getting bigger. So each year that your deficit is growing, and
just
so
by
that's the problem.
growth.
It's just math, right? So think about it. So now you've got $31 trillion of debt in the United States right now, right? So if your interest rate, which is why the Treasury is like they're on guard here.
Yeah.
So you got $31 trillion up there on the left, right?
Yeah.
So if you've got right now, if they're paying, what did we come up with?
It was 1.5%. They're funding themselves at 1.5%. Make the math easy. On 31 trillion, they have $450 billion annually of debt. Right, Peter? Look at the top, 30 trillion times 1.5%. That's 450 billion annually, which James pointed out. 38% of that debt rolls over in the next 2 years and will be funded at a 4% coupon because that's the open market rate on debt now.
Okay.
So there is the growth in your interest expense.
Right.
You go from a 450 billion to meaningfully higher because the debt rolls at a much higher coupon.
Hold on, question.
Yes.
I think I've just realized something that I hadn't fully realized before. When you just said the debt rolls over,
Yeah.
because they have to pay off the old bonds, they have to issue. They have to issue the new ones to roll it over.
Yeah.
Exactly.
Right. Okay.
Exactly.
Now here, one thing I want to mention.
Over from
I want to mention this,
1.3
Danny.
to 1.5% to
Peter,
4.5.
Here's how crazy it is. Everyone focuses on the U.S. national debt in the top left corner.
I'm looking at US total debt.
Where do you see that one?
93. Oh, fuck.
No, go down to the bottom
All the way
line.
down.
Holy
US
shit.
unfunded liabilities, 170 trillion.
Hold on. We nearly need
So
a
add
new.
that to the 31.
What comes after trillions? Is it quadrillion?
It is. But let's not even go there because that's $200 trillion. You take your unfunded here, 172 plus 30, you're at $200 trillion of total obligations by the U.S.
Hold on. Okay, so say $200 trillion. What are those unfunded liabilities?
Medicare and Medicaid. It's right there. You see them right there. Medicare liability, Social Security liability.
But over what period?
It's on their books now. It's the promises to the citizens going forward.
Yeah, but like
30 years?
Okay, 30 years.
Yeah.
Okay. Shit.
No, but this is math.
This is and
This is the math.
and this is why you need inflation to.
It's over.
But go down to the lower right. See what the liability per citizen is?
Fucking insane.
It's not funny though. These are our kids, Peter.
No. But it's so fucking stupid.
It
It's
is
funny.
exactly that.
It's
Now,
like
you said,
insane.
how did we get here?
Yeah.
Any 4-year president that's going to try and fix this will not be in office for another term.
Well,
So he is not incented to fix this. It's besides it being mathematically impossible to fix.
Unless they elect a guy who probably won't be alive by the end of it, and then maybe he can have a go.
We've had enough people that shouldn't be in office at that age anyway. But
go back up just a couple of lines. You see the U.S. millionaires down there? You see the number of millionaires?
22 million.
There's 22 million millionaires. How many Bitcoin are there going to be ever printed?
21. This is a great chart, and they do this by country, right? You can look at this same thing for Canada. Let's not do it.
So they will not
22
all
and
be
a
able
half.
to get one.
22.
not
Actually, right.
mathematically not possible.
23 millionaires.
Yeah. Just here in the United States.
Yeah, that's ridiculous.
There's
Hold on, that's more than
50
5%.
something. Yeah, 50 something in the world.
Yeah, close to, it's probably 7%. So if there's 300 million people, 7% times 300 is 21 million.
Yeah.
Jesus.
Yeah.
This stuff is insane.
It's math. This is why it's so simple to see this. And then we could get into the credit default swap market, and you could see how Bitcoin, even just on the United States, should be valued at somewhere close to $200,000 just because of the insurance on the USA. And then you get all the other countries for free.
What does it used to say? Bitcoin is a credit default swap on. Used to say something.
On a basket of fiat currencies, but you could just do it as a credit default swap on the USA and see how cheap Bitcoin is.
Oh my God.
But you see, here's the cool thing,
okay.
Peter.
Yeah.
We've been involved, you and I, talking about this, and I love the aha moment. You just had your aha moment.
Yeah.
Well, no, there's certain concepts you just suddenly get.
That's fine, but you have to keep repeating it because
Yeah.
most people don't. It's like when you, James very well did.
Sorry.
Go ahead.
One that stands out to me, savings per family. 9,500.
9,500 versus the liability per citizen.
Not good.
500. So what's the average family in the USA? 4. So the average family has $2 million of liability, and the savings for family, a whole $9,500.
I'd love to see a UK version of this.
There is a UK
It's
version.
there.
There is?
Yeah.
Oh my God, let's have a look.
You get your public debt to GDP 104% versus USA. Well, that's the public debt, but you got to take your
Well, the
total
UK
funding.
just jumped over 100% this year.
Yeah. But these are cool. I mean, but it's not a good scenario. And the best scenario is the USA.
Oh, look at it. Italy's fucked.
No, well, that's why we always said
Oh
it.
my God, yeah.
But let's not spend too much time on it. It's that simple. You need insurance against this.
There's no way back.
Mathematically, no.
No way
So
back.
what do you think they do, Greg?
So
Pardon me?
What do you think they do?
The countries?
Yeah.
We go into something called financial repression, and James will expand on this, where you try and run inflation hot,
Yeah.
and then you use a component called yield curve control, which keeps your interest rates low, and you hope that your GDP grows into your debt burden
Right.
because of the natural inflation to your tax base, which follows inflation. But bonds get skewered, and the printing of money is so crazy, it's QE infinity, and hard assets go parabolic.
So just
to the
remember that
upside.
your nominal, you're getting this bump in GDP from inflation, and nominally you're paying back these. So what Greg is saying is that you're paying back this debt with future dollars that are worth less, right? So if I give you $100 today and loan it to you, you can buy 20 Starbucks, right? So in 10 years, how many Starbucks do you think you're going to be able to buy with that $100?
Maybe 5.
Right. So that's exactly what they're doing with the debt. It's the same thing.
Yeah, well, this was a conversation I had the other day. You know, we run a successful business here, and I don't know what the fuck to do with the money. We've put money by as a runway for the business, but also at the same time, I'm going to lose 15% of that next year by not spending it.
You're totally right.
What the fuck do you do? You can't put.
That's
can't
why
put
it's evil. It's ridiculous.
Yeah, it is. It is fucking evil, and it is ridiculous, and it's insane. And
It's maddening. Yeah.
Yeah, maddening.
okay, yeah.
It's maddening.
I have
and that's
3
it. You
kids.
try to be portfolio managers. That's why everybody's reaching for yield to try to they're trying to keep ahead of all this printing. You know,
How long do you think they can last before they have to start dropping rates again?
Well, I said that 4.5% would be where things really start breaking. We're starting to see things break already. LDI in the UK was absolutely something that broke.
Yeah.
Okay, so we're seeing things break, and the best economists that I follow, economists like Luke Roman, feels the same way. There's a sustainable amount of interest expense that the USA can endure, and we're at that level right now. And just look at things that are breaking around the world.
But to sustain that acceptable amount,
you can't sustain it at this rate.
What I'm saying, if they can find an acceptable rate, they can maintain that. That is going to lead to a gradual and insidious erosion of living standards
100%.
for everyone.
Right, because what they'll do is
100%.
they'll jack up the rates as quick as they can here, which is what they're doing, and try to get that inflation down to a point, right? Declare victory, probably somewhere around 4 or 5% inflation, which is the number that they're sharing with you. But we all know that the real inflation rate's higher. And then back those rates off so they don't have to pay higher rates for the treasuries that they issue, right? That they issue in the auctions.
Is there a sensible option that no one's putting on the table because it's politically unpopular? Is there like something you guys go, wow, if they did this, or is it literally?
They had a chance to do it after the great financial crisis, and every time they tried to do it, there was a taper tantrum. So now there is a point. There is no return.
No debt jubilee?
Yeah, they kept. I wrote a piece on that. No, I mean it doesn't physically work. You leave a hole in a balance sheet, in the Fed balance sheet.
What do you think that would do to pensions?
So
Then it's
Look, there's one option. All paths lead to Bitcoin.
Yeah,
It's that simple.
Yeah, and it's going to be a messy, strange transition that won't be pretty.
It could be. It could be. Like people, I mean, look at how long it's been going on with Japan. We don't know how long it takes, you know?
Well, that's careful. Japan is a nation of savers versus
absolutely.
The difference
and so
between.
It's hard.
Also, isn't the currency collapsing?
Right, but okay, let's say it.
It is.
So, okay. So Japan is a nation of savers and they're a net exporter. We're a net importer. Okay. So it's a different dynamic. Absolutely. However, also a different dynamic. We've got the reserve asset of the world, which is U.S. Treasuries, and everybody needs dollars, and everybody uses Treasuries. So that's our advantage, the United States advantage, right? So the one that'll break first is Europe. You know, that'll break before Japan.
But was it Jeff Snyder who said that it won't break because the U.S. will actually have to rescue Europe?
Okay, I mean,
he talks about
I agree with Jeff on certain subjects, and I also don't agree with him on some. But that's what makes a market. All right. Look,
when Europe breaks, is it the euro that breaks, and will the pound be independent of that?
Well, it depends. It depends on what actually the function of it breaking is. But I believe that, and I've written about this. I believe that eventually Germany just gets fed up with all of the debt that the ECB is allowing these other countries down in the south. You know, the Italy, Greece, Spain, Portugal, to take on at the expense of Germany.
Yeah.
And there's no function to pay it back. You know, I wrote about it in Target 2, the interchange. And so they're owed over $1 trillion. And some of that is from the ECB itself.
And
there's no function to pay it back. So at some point, Germany will just say, you know what, we're done with the euro. Maybe we're done with Europe. It's going to be... Yeah.
If that happened, and say it happened the other way first, say Italy voted for its own Brexit and went back.
How would it? What would it do?
I don't know. I'm just saying, just any country. Just say one did.
I'm not sure how they would financially do it without. If Italy wanted to leave the European Union and not have the ability to use Germany's balance sheet,
is there a way
those banks would fail?
Is there a way those a country can leave the euro, leave the EU, default on its debt? Establish its own
reset.
A reset. Establish its own domestic currency.
What are the other countries going to do?
But would that lead? Well, I'll come back to that. But could that lead to a boom?
No,
it couldn't.
No,
because people won't trade with them because they'll have a poor credit rating.
They'll have to use other. How are they going to issue debt? Who's going to buy that debt
if they just defaulted on their obligations?
They're not going to buy that debt, and you need to be able to issue debt. Yeah.
Let's not overthink things. Okay, the USA will be the last country to fail. Canada will fail, in my opinion, 10 to 20 years before the USA does, and Canada hasn't failed yet. So let's assume that this can continue. I think to answer Danny's question, how long can it go? Probably at least another decade. Why? This is the Ponzi. It's the FTX. As long as you don't let people see what the true mark should be, we can continue to pretend this Ponzi will continue to go.
Yeah,
and perpetuating the Ponzi, is that oppressing smaller developing nations?
Crowding out of capital. Of course it is. It's crowding out the capital that, there's a limited amount of capital in the world. And as the USA becomes a greater and greater borrower, it crowds out the ability of capital to flow to lesser fortunate nations.
And the stronger U.S. dollar just it exports our inflation, right? It makes it more expensive for people to buy U.S. goods. And so,
does any of this make you suspicious of what's happened in Russia and Ukraine? That was Russia recognizing this?
Oh my God!
And Putin wanted to detach himself from
Absolutely. He doesn't want U.S. dollars for his valuable natural resource energy. He basically called it out to his Politburo.
Exactly. He said it.
You take the translations. It doesn't get much MSN coverage, but you look at the statements translated. He basically says, why would I want to own a fiat currency?
Paper-based currency.
That they can restrict me from using when I need it.
Yeah. It was
brilliant.
Yeah.
Putin's a Bitcoiner. I'm not supporting his military or his anything like that, but he understands the difference between soft money and hard money.
Do you think that's a bit of a peek behind the veil for people like China as well, who won't want those treasuries?
Not necessarily China, but how about we extend it to, what's happened with the Saudi Arabia kingdom and disagreements with President Biden is the same thing. They don't want their valuable oil resources being paid for in US dollars. Now, there is that agreement because they need to have protection from their enemies from the US military.
Right.
So it's difficult. But it all comes down to energy. It all comes down to natural resource energy for digital energy, hence Bitcoin. Yeah. Pretty simple.
Super simple.
I need a whiskey, man.
That being said, all paths lead to Bitcoin. The longer that we can develop a parallel network, the better. And that's what we're doing right now.
That's right.
We're developing this rescue network. Be positive, not negative. Because, drink whiskey because the reality is, it's not a pretty situation.
There would be a US dollar and US Treasury kind of parallel system until Bitcoin just takes over.
And it will replace the US Treasury system as global reserve asset. Yeah. And the US dollar can maintain global currency status.
Have you independently come to that conclusion, or was this part of the conversation?
No, independently. That's why I loved it.
It's going to replace the bond system, did you say?
It will replace the US Treasuries as global reserve asset, not global reserve currency. And this is why.
What's the trigger? What's the trigger?
Jason Lowry. Right Jason Lowry. The trigger is Jason Lowry convincing his superiors that the survival of the US dollar could rely on Bitcoin.
Huh.
That simple.
Yeah. And
I've got some Canadian bourbon here. So.
let's call it a great day of talking.
Oh man, that was amazing! Thank you so much, Foss. Love you, man. James, great to meet you.
Awesome.
Do you want to? I don't know if you've got anything you want to send anywhere. Have you got a newsletter or?
Yeah, he has a great newsletter.
Yeah,
so I'm on Twitter. I'm just James Lavish, and I write a newsletter. It's called The Informationist.
Okay,
and it's gotten a ton of great reviews from people who. What I do is I take one financial concept every single week, and I break it down super simply for people to understand it, anybody, because I know how opaque our world is, and I want to get people inside to see exactly what all these things are: yield curve control, the Fed pivot, target 2, whatever it is, and why it matters. And it often leads people right to the end of it is why Bitcoin is so important. And so
James and I are partners on the Looking Glass education platform, right? That's one of the, he was one of the founders of this free education platform that we're happy that people refer to as an alternative source of education to understand the situation that we're in.
All right, man. Well, listen, we got to get out to Canada, Danny. We've got to get out, go watch some hockey, do some interviews.
Thank you for having us, Peter.
Yeah. Foss, anytime. Lavish, great to meet you. Good luck with everything. What's the URL for is it a Substack?
Yeah, it's on Substack. You can find it right on my Twitter handle.
Is this the one you've been reading?
Yeah.
We'll put it in the show notes. Substack's become a bit of a Ponzi for me as well, for the amount of bloody fucking newsletters I'm signed up to. I can't keep up with them all. Doomberg has been the one I've been reading a lot.
He's a good man.
Yeah.
He's good.
Guys, thank you so much. James, we'll have to do this again sometime. Foss, whenever.
I'm a huge fan of what you're doing. Bitcoin Collective, shout out to them, what they did in Edinburgh. Shout out to your football team. I tell you what, this movement is growing. I'm off to El Salvador tomorrow
for adopting Bitcoin.
Look, that's what's going to do it is more adoption, more real life use cases, and for the kids.
Raoul Bedford's going to be your 4th asymmetric bet.
I could is it available for public investment?
Not yet. I said I was going to.
So then it's impossible for me to execute it.
No. What it is I wanted to do one season first and go and learn it and go and say, okay, I know what to do now. Okay. I've done it. I've learned it. I can do this. This is what it is. And then I was going to open it up to anyone to invest.
Awesome.
Well, so James and I are starting an investment fund together. I'm joking, of course. Our first investment, as much as I love you, kid, it won't be Real Bedford.
To be honest, Real Bedford investment needs to be investment of love and fun.
There we go. Just like Bitcoin.
Yes. Yeah. All right. Thank you, guys.
Thank you, brother.
Thank you.